I'm pleased to report that Indie exceeded top and bottom line expectations and delivered another record quarter in Q2, driven by robust, broad-based demand for our highly innovative auto tech solutions. Our outperformance versus the automotive industry reflects the strength of Indie's key Tier 1 and OEM partnerships, our differentiated product portfolio, underlying intellectual property, and our world-class organization. I'm especially proud of our team's operational resiliency and ability to scale above our commitments amid persistent global supply chain headwinds. Specifically, during the second quarter, we once again substantially outpaced our addressable markets and grew revenue 181% year over year and 17% sequentially to a record $25.8 million, while expanding gross margin to a nearly 49%. As we'll outline, our design win momentum is accelerating across ADAS, user experience, and electrification applications, setting the stage for the establishment of Indie Semiconductor as an auto tech powerhouse. On the LiDAR front, we extended our Surya SoC development program and added additional customers during the quarter. In fact, we are now working closely with 4 partners for this design phase as we absorb their inputs and implement their suggestions. Surya is a truly unparalleled LiDAR solution given the degree of system integration encompassing DSP, analog, mixed signal, and firmware functionality, augmented by Teraxion's world-class lasers and associated technology. Leveraging all of these capabilities, we are uniquely enabling a complete $200 BOM, 80% less than current discrete architectures. As a result, we believe Indie can catalyze this key 3-dimensional imaging technology, which is pivotal to enabling the future of autonomous driving. At the same time, radar is gaining widespread market deployment for ADAS, ranging from adaptive cruise control to blind spot detection to lane monitoring to pedestrian detection applications. According to IHS, the semiconductor total addressable market opportunity for automotive radar is $1.8 billion this year, growing to $4.3 billion by 2027. Comparatively, LiDAR is expected to grow from $150 million to $630 million respectively. To be clear, we are heavily investing and intend to gain share within both of these modalities, in addition to ultrasound and computer vision, but it's worth recognizing that although LiDAR has received intense investor attention through high-profile listings of a dozen or so companies, it is a future growth vector, while radar is a large silicon opportunity today. As the radar IC market was over-consolidated over the past decade, our customers were seeking an alternative source with leading-edge multi-gigahertz RF, precision analog, power management, and microcontroller-based digital capabilities, as well as scalability and strict adherence to all key quality standards. This encouragement formed the rationale for our recent acquisitions of onsemi's radar design team and Analog Devices' Symeo division, bringing together field-proven radar solutions, over 250 man-years of cumulative development, 205 related patents and applications, as well as world-class mixed-signal SoC capabilities, ultimately enabling Indie to capture our largest strategic program win ever. Switching gears, within the user experience product area, during the quarter, we launched a dual-channel USB power delivery IC that reduces component count, simplifies designs, and enhances reliability of in-cabin vehicle charging systems. This breakthrough product becomes part of the next generation of enhanced user experience applications adjacent to our existing CarPlay products and is the automotive industry's most integrated USB PD firmware-based programmable controller. We commenced sampling in Q2 and have already multiple customers staging high-volume production ramps for early next year. Further, we announced the formal opening of our Dresden, Germany Engineering Center of Excellence. We now have over 100 engineers in the European region, the second largest vehicle market in the world, accounting for approximately 20% of global production. And we are similarly intensely focused on our expansion efforts in Asia. Recall, we announced that we launched a strategic presence in both Japan and Korea 90 days ago. Subsequently, we were able to secure wireless charging and advanced lighting design wins with major Japanese and Korean OEM brands, including Honda, Hyundai Kia, as well as Xiaopeng in China. These wins are significant, given we've historically not had any foothold at Honda and we've been underrepresented at Hyundai Kia. Given the massive sales channels we've opened for Indie's current and future product offerings, we look forward to sharing our annual strategic backlog update next quarter and providing similar updates on new customer wins and product launches going forward. Finally, and at a higher level, the shift to electrification is accelerating amid the higher oil price environment and long-term transition to greener technologies. According to Cox Automotive, EV sales grew more than 75% in the first half of 2022, while overall U.S. auto sales were down more than 17% over the same period. In fact, according to a recent AAA survey, 25% of Americans say they plan on buying an electric vehicle as their next car purchase. Further, data from Recurrent, an automotive market intelligence firm, has indicated that consumer interest in buying an electric vehicle has soared 70% since January, particularly for younger generations. And with only 5% penetration of new vehicle sales in the US, the shift has only just begun, while Germany and the Netherlands are seeing significant increases in penetration, with fully electric vehicles now capturing 14% and 24% of respective new vehicle sales year to date through the end of June. The electrification megatrend benefits indie in a few ways. First, we have strong relationships with an increasing number of strategic EV OEMs and are gaining design win traction there. Secondly, and more tangibly, we are supporting Vitesco, one of the largest European automotive tier ones, in an EV-specific application. And third, and more generally, our broader Autotech portfolio tends to gain a substantially higher attach rate to newly designed electric vehicles given our degree of innovation and power efficiency, critical to maximizing vehicle range. Between our addressable ADAS, user experience, and electrification applications, IHS forecasts average content per vehicle to increase from $500 today to up to $7,000 in some luxury vehicles over the coming decade, and our customer base and our product portfolios are perfectly aligned to capitalize on this deep content growth trajectory. With that, I'll now turn the call over to Tom for a discussion of our results.
Indie delivered strong second quarter results, once again achieving the top end of our forecast range, exceeding analyst expectations. In fact, Q2 represents our fifth consecutive quarter of outperformance versus plan post Indie's IPO last summer. Revenue for the period was up 181% year over year and 17% sequentially to a record $25.8 million. Gross profit was $12.5 million, translating into a 48.6% gross margin, up 650 basis points year over year and 120 basis points sequentially and above our 48% guidance. Operating expenses were $29.5 million against our outlook for $30 million. R&D investments were $22 million as we accelerated product development, while SG&A of $7.5 million supported our expanded sales reach and the last elements of public company infrastructure, including a global ERP system for enhanced scalability. As a result, our operating loss was $17 million. Interest and other expenses yielded $100,000 and taxes were negligible. In turn, our net loss was $16.9 million, with a loss per share of 11 cents on a base of 148.7 million shares, a penny better than consensus estimates. Turning to the balance sheet, during the quarter we invested $4.9 million in working capital, including $2.2 million for inventory to ensure supply and support of our stronger second half growth plan. And we licensed a key IP block for another $2.2 million. Our capital expenditures were $1.3 million for additional lab equipment and expanded IT infrastructure. Finally, we made $6 million in deferred acquisition-related payments to onsemi and City Semiconductor, exiting the period with $164.1 million in cash. Looking forward, based on our strong order visibility from new products and customer ramps, we expect to continue to substantially outpace Indie's addressable markets. Specifically, for the third quarter of 2022, we anticipate top-line growth on the order of 140 to 150% year over year. At the midpoint of this range, Indie will be on a roughly $120 million annualized revenue run rate, and for the first time, we plan to deliver gross margin in the 50% range. We are planning to moderate operating expenses with $23 million in R&D and $8 million of SG&A. Below the line, we anticipate a pickup of $300,000 of net interest income and no taxes. Assuming 149 million shares outstanding, we expect a net loss of 11 cents per share, once again 1 cent better than consensus expectations. More importantly, given the depth of our design win pipeline, demonstrated scalability, and planned operating leverage as our revenue growth and gross margin expansion far outpace our cost structure, we are on track to reach profitability in the second half of next year, marking another key step towards achieving our target model of 60% gross and 30% operating margins by 2025. On that note, I'll turn the call back to Donald for his closing comments.
To summarize, Q2 was another solid quarter of performance for the Indie team. Even with leading automakers in the US, Europe, and Asia reporting down unit volumes during the first half of this year, we are delivering exceptional results and guidance, far outpacing industry peers, which we expect to continue over the planning horizon. Indeed, the next generation of automobiles are showcasing technologies focused on enhanced safety capabilities, better in-cabin features, as well as more environmentally friendly powertrains with extended range. Our differentiated portfolio of semiconductor and software solutions are positioning Indie to gain a disproportionate share of what is fast becoming close to a $50 billion serviceable market opportunity for Indie. We look forward to updating you along the way. That concludes our prepared remarks. let's open the call for questions.
The first question comes from Suji DeSilva from Roth Capital.
Hello, Donald. Hello, Tom. Congratulations on the progress here. So I just want to kind of ask a general question. I know you covered it a bit on the call, but the auto supply chain availability, what are you seeing here, updated situation, easing, and just or not, and just what the impact on Indie is, or if Indie's kind of immune to that dynamic?
I mean, generally speaking, our progress is really defined by share gains and content increases in the automobile space. So, I mean, it's no secret that the unit volume is down, but we've been able to ride that out and meet our planned numbers as we set out in front of us. We do see some spot areas in our supply chain, so the input to our business, if you like, easing. It's certainly easier than it was a year ago. In the output from our business, the supply chain of our end customers, there's still some disruption also. The so-called golden screw phenomenon, which is really the key thing, which is slowing the unit shipments from the OEMs. But as far as we can tell, there's still no shortage of demand. So nobody's immune to it, but I think we've ridden the bumps pretty well.
And then, I'm hearing from various sensor companies, some of your competitors perhaps, that there's a focus on model year 26, which if L2 plus, L3, which if we pull it back would be decisions being made in the second half of this year, next year, or first half next year, and ramping in 24. What position, what are you seeing for Indie's positioning among increasing sensing that would go into these L2 plus, L3 models? What should we expect in terms of your traction and penetration there?
I mean, you can assume it's extremely strong. We've made heavy investments in all sensor modalities, which will be required for the various levels of autonomy and ADAS features. We take a view that we right-size our products for each individual application. So you'll find us in high-end cars, and also you'll find us in high-volume cars where the features are deployed in sort of mid and lower tier models. Indeed, we've gone through a lot of the selection processes already in the business that we've talked about publicly. So we're on track to see those things deploy in the time frames that we specified when we came out with the announcements. It's a good tailwind for the whole industry, and especially and also for ourselves. There are carve-outs who are, of course, the focus is manufacturing, but there are carve-outs which are focused on design also, and we expect that given that our focus is very heavily centered around one of the US's key industries, we should be a good candidate to benefit from that. So, for us, we view it as a positive.
The next question comes from Ross Seymour from Deutsche Bank. Please go ahead, Ross.
Hi guys, thanks for letting me ask a question. Congrats on the strong results. Donald, I want to talk just about the comfort you have with getting to the break-even / profitability in the back half of next year. You guys have long set that as your target. You've executed very, very strongly to it. I just want to see, what are the primary bridges between here and there from the revenue side? It looks like the revenue has to basically double from your third quarter this year to your third quarter next year to get you in that ballpark range. What are some of the key drivers and your comfort behind those drivers to attain that growth?
Yeah, the results speak for themselves. We're still executing to our plan, and every quarter we've made the correct amount of progress that we expected as we went, and we have strong belief that will continue to happen. We have very good visibility of our backlog and our outlook into 2023. And you're right. I mean, we have to double one more time. We've done it twice already, and so there's nothing that I can see in front of us that would inhibit that happening for us. In terms of the products, it's very well diversified across basically the whole gamut of product portfolio that we brought to market. So within that environment, we're pretty well diversified. We're not depending on one customer or one product, and with that in mind, the risk is pretty well mitigated. So we feel pretty good about it.
Great, thanks for those details. I guess that's my one follow-up, one for you, Tom. The gross margin just keeps marching higher. I know that's part of the plan. But as we think about the ability to grow going forward, what's the pace we should think about there?
It's pretty linear. It's driven by, obviously, our mix just continues to improve. We're seeing better second and third generation pricing and product margins. And then also, as these newer, higher value programs layer in, we're benefiting from that as well. So all those dynamics get us there.
The next question comes from Anthony Stoss from Craig-Hallum. Please proceed with your question, Anthony.
Hey guys, my congrats, nice execution, particularly on the guide as well for September. Donald, I wanted to follow up on your comments about the new Power IC USB PD controllers. You're landing customers pretty quickly. Can you maybe share or shed some more light on why it's a breakthrough and why you're winning these deals as quickly as you are, and then add a follow-up after that?
Well, it offers a level of performance which wasn't previously available in an integrated product. It's a coming together of our digital technology, our digital controllers, our firmware-based controllers, and sort of embedded ARM subsystems, together with some pretty extreme power management to go along with that. There's some very tricky problems to solve when you get to those power levels, to charge up to 100 watts in some cases. And it's been a very successful development for us. Nobody's as integrated as we are, and we're seeing that bear out in the customer reaction and the backlog filling up.
Got it. And then lastly, just in the press release on your prepared remarks, you talked about Hyundai, et cetera, on the lighting design and wireless charging. Can you discuss kind of what you expect time-wise and volume related? You said they were big contracts. I'm just curious when they're going to start kicking in.
They will contribute in 2023. There'll be a ramp over period, of course, but what we're seeing in the market is, in some cases, some acceleration of the design win flow, perhaps driven a little bit by some of the supply chain constraints. And so, yeah, we do see that will be a faster time to revenue than we're typically used to.
The next question comes from Cody Acree from Benchmark. Please proceed with your question, Cody.
Yeah, thank you guys for taking my questions, and congratulations on the progress. Maybe just to follow up on the last question, just the size or scale of the design wins that you're talking about winning here and ramping in 2023. Is there any color you can provide to that?
We typically don't release specific numbers, but they are material.
And I guess also Chinese activity. Can you just talk about what's happening there from the year standpoint, and what do you see happening in the overall China market?
The overall China market is very buoyant. The foreign joint ventures, which we serve over there for companies such as Volkswagen, General Motors, etc. Also the local companies. There's a very buoyant sort of portfolio, if you like, of e-vehicle companies who are extremely hungry for feature adds, because in that market the sort of bells and whistles are really key in order to drive sales for them. So we see it very buoyant at the moment. We see a fair bit of backlog coming from that place across the board for a lot of our products.
And are you, from a backlog standpoint, constraints limiting your performance?
Not as such. The management of our supply chain has been pretty good through, as I think you will recall from previous quarters when things were super tight. We've managed to manage through that. It hasn't been an easy task, so we've had to be on top of our game in order to do that. You will have seen that we invested a little in inventory this quarter to mitigate some risk there, but at this point, I think we're doing pretty good.